Chairman Burgess, Ranking Member McGovern, thank you for the opportunity to present the joint work of our two committees, the House Agriculture and House Financial Services Committees. Let me start first with H.R. 4763, the Financial Innovation and Technology for the 21st Century Act, or FIT21. Mr. Johnson and I were pleased to co-author this groundbreaking bill with Agriculture Chair Thompson, along with our colleagues Warren Davidson and Tom Emmer. In the wake of FTX's catastrophic collapse in 2022, Financial Services Committee Chair McHenry, Ag Chair Thompson crafted a set of principles to assure that we needed legislation to protect consumers and establish clear rules of the road, whereby good actors who want to innovate responsibly have that kind of regulatory clarity. Absent clear rules, we will continue to see the SEC pursue a regulation by enforcement agenda that leaves market participants fearing that they'll be subject to litigation at a moment's notice if they continue to operate in the United States. Who does it hurt the most? Our constituents. FIT21 alleviates this concern by leveraging the existing capabilities of the Securities and Exchange Commission and the Commodity Future Trading Commission. I'm proud to say that this bill is the product of countless bipartisan discussions between members of the House Financial Services and Ag committees. Despite this, some may argue that the SEC's concerns with the legislation should trump our work. Let me be clear. We incorporated a significant amount of feedback from the agencies, including the Securities and Exchange Commission, as well as members of Congress and market participants, all during the past 14 months. With FTX collapse fresh in our minds, we wanted to ensure that the United States avoided future fraudulent activity conducted in the same manner as we witnessed in FTX. As such, this bill imposes strict consumer protections that do not allow commingling of customer funds. We included provisions to mitigate conflicts of interest. We impose capital and other necessary requirements on intermediaries, and we impose higher standards for custody. While market participants wait for rules to be finalized, we include an interim oversight process where entities will need to file a notice of intent to register with the SEC and the CFTC, thus subjecting themselves immediately to federal regulatory oversight. Again, my colleague from California, the ranking member, may say that the status quo is preferred and that the SEC has all the authority that it needs. But let's consider what the status quo for a second. We have a $2 trillion industry, with a majority of which is subject to very limited federal oversight. If the existing ad hoc process remains in place, I'm convinced we'll continue to be plagued by future FTX-like situations because consumers are not afforded the careful protections crafted in this proposal. This bill does not create securities loopholes. This bill does not deregulate crypto. Quite the contrary, this framework recognizes the unique characteristics for the evolution of blockchain networks so that consumers can receive similar protections that they have today in traditional financial markets. We accomplished this by creating a fit-for-purpose disclosure regime where investors are regularly provided with material information about a digital asset being overseen by the SEC or the CFTC. Regardless of what some critics claim, this bill does not create a light-touch regime for crypto crooks or prevent the SEC from being able to police its markets. We closely emulated the SEC's current registration exemption regime for the offer and sale of certain digital assets. We are not reinventing the wheel. However, we're clarifying why restricted digital assets are unique from traditional securities and should be regulated differently. This follows the principle that we've had from the beginning: same risk, same regulation. This bill also gives the SEC clear authority over restricted digital assets that are not certified under the legislation to be considered as a digital commodity. However, if these digital assets do satisfy the standards set forth in our bill, then those assets would be traded as digital commodities and be under the watch of the CFTC. FIT21, Mr. Chairman, is a watershed moment for entrepreneurs and innovators, and more broadly, our country. Now let me turn to highlight the importance of Whip Emmer's H.R. 5403, the CBDC Anti-Surveillance Act. This bill is very simple. It prohibits the Federal Reserve from issuing a CBDC unless it's open, permissionless, private, and fully preserves the privacy protections of cash. Fortunately, the U.S. Constitution expressly grants Congress the sole authority to coin money and regulate the value thereof. However, vague statements from the Federal Reserve about the legal authority to issue CBDCs necessitate this legislation. We must make it completely clear that authorization must come directly from Congress. Claiming that a CBDC is needed for faster payments further ignores the private sector innovations. CBDCs put the government in a place where they don't belong. The only benefit that a CBDC has is increasing surveillance and control over Americans' financial lives, which flies in the face of America's right to privacy. I thank the committee for your time, and I look forward to our discussion.